The war on Iran is not affecting my next guest's bullish outlook for the S&P. Let's go to Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, thanks for joining us today.
Hey, thanks for having me on a green day. It's kind of nice.
On a green day, just how much of a risk does the Middle East conflict pose to your assessment?
Oh, well, it definitely in the near term, it absolutely does. I mean, we understand the severity of it, the uncertainty that we see out there. At the same time, no easy way to kind of slice and dice this other than be factual. When you look at history, when you have these major geopolitical events, if the economy, at least specifically the United States, is still solid, you tend to get through them just fine. And it doesn't mean it's going to be easy. It doesn't mean it's, we're going to go straight up from here. But once we can get through this and get hopefully some type of resolution, it's just hard for us to think this is a midterm year. Do we really want to be talking about this all summer long, going up to the midterm elections in November? We just don't think so. So hopefully, knock on wood, we can get some type of resolution. And the fact that we're still in a bull market, the U.S. economy just had some good manufacturing data, some solid earnings season, some solid services number, getting more in the weeds of it if you want. We still think it's a bull market, though, and we would not be selling or panicking right here and now.
Okay, so when would you panic? This is apparently going to go on at least a month. That's what we're hearing from the president. Yeah. But his goal, as you know, has not been very clear. It's moved a couple of times. So at what point do you start to go, uh-oh, we're in trouble?
Well, there's a couple of answers I can give here. I mean, I like to follow what the credit markets are saying, right? High yield spreads, triple B spreads. If the credit markets start to panic, I don't ever like to use the word panic, but if the credit markets are panicking, we might be a little more concerned about things. We're not seeing that. Also, advanced decline lines. I mean, we're still seeing broad. Today was a nice day, I get it, but even the last couple of days on the down days, we had broad-based, for the most part, participation, which is a good thing. Now, I'll also put it like this. We manage a lot of money at the Carson Group. I mean, we're fairly diversified. You don't have to just be all in U.S. stocks. We're overweight equities, yes. We own stuff around the globe. We own some gold. We own some managed futures. We have some bonds. We have some cash. In times of uncertainty like this, diversify. When in doubt, diversify it out. You don't have to just be all in or all out. We think being diversified, especially right now, it'll help you sleep at night and get through this and eventually back to that regularly scheduled bull market.
All right, Ryan, you say the early part of the year is the banana peel part of the year. What does that mean?
Yeah, when you look the last 20 years specifically, from about the middle of February to about the middle of March, so right where we are now, it's been historically quite weak. So I've been calling this for a while, even before this weakness started. This is the banana peel period where you kind of slip a little bit, but you get up pretty fast. I mean, we don't expect anything major, and now all this news is happening. So I guess, let's also put it like this. The Dow is up 10 months in a row. The Dow's been around since 1896. This is I think the fourth or fifth longest monthly win streak ever at 10 in a row. Some choppiness and volatility. I don't think that's abnormal. In fact, after the run we've had, it's probably necessary and needed to kind of flush out some of the weak hands. And that's, just yesterday, I had that VIX spike up close to 28, puts a call ratio spiking, and we get why. I mean, the headlines are the headlines. Oil soaring. There's a lot of stuff to be potentially worried about. But that's how markets work. And we think with all the negativity out there, if we get some good news, and like you said, it might go another month. I mean, listen, if that goes another month, we might still be in this choppy phase. But also, we know President Trump. This stuff can change in a hurry, too. So we'll just buckle up, I guess.
Okay, so you're calling for 12 to 15% gains for the S&P 500 for the year. Walk us through some of the reasons you are or remain bullish.
Yeah, so again, 12 to 15%. If you don't have a recession, which is, again, is our base case, if you look in history, I mean, the market's up like 70% of the time and up right around that 15% mark on average without a recession. So that's number one. But also, we just had a really strong earnings season. Earnings drive long-term stock gains. I think earnings came in at 14.2%. This time 2 months ago, expected to be 8.2. So way better than expected, which is a great thing. Also, we have all the fiscal stimulus, the monetary stimulus, the AI spending. I know the AI spending hasn't really helped AI stocks. We understand that. But it is helping the economy here. So those are some what we call tailwinds that are still in play, that are still there. But record earnings and record profit margins, end of the day, are the two reasons we've been bullish for quite a while now, and those aren't slowing down, justifying this bull market.
Okay, so let's talk about where to put the money. You mentioned diversification at these times is key. You are saying investors should be overweight, though, in equities and then lean into things like materials and industrials. Can you talk about that a little bit?
Absolutely. So again, we don't see a recession like I've laid out. So you don't want to be in the pure defensive areas. We're in a world we think where there's going to be a little bit more inflation, right? We've seen some recent data in the U.S. Inflation's a little stubborn. And if you're in a higher inflation world, you do want to own equities, yes, but you also want to own real assets, own hard assets, potentially some managed futures. Again, we have some gold there. I say if you drop it, hit your foot and it hurts. You might want to own some of those things, not in place of bonds, but along with bonds as well. And then on the equity side of things, again, this is a global bull market, as most listeners know. I mean, right now the S&P is like less than 2%, an all-time high. A lot of global markets are right there as well. So, of course, I'm U.S. centric, based in the U.S., but we, Carson Group, for over a year now, have been saying, look around the globe. I mean, developed international to us still looks really good. I know it's had a great run, but look at what earnings are doing there. Look what earnings are doing in emerging markets. Those are soaring higher, justifying it. So be overweight equities, but have more of a global tilt. And on your other bucket of more diverse your bond bucket, so to speak, don't just be all in bonds. Be a little more diversified, because bonds haven't been helping as much lately. The last couple of days, yields have gone up, right? Bonds haven't done as much. We've seen periods where bonds haven't given you the zig when stocks zag. That's why you want to diversify that bucket as well.
All right, Ryan, got to leave it there, sir, but appreciate your time. Thanks for joining us. Ryan Detrick is with Carson Group.